Okay, so you might be looking at your investments right now and honestly feeling a bit seasick.
Huh?
Stocks are up, down, all over the place. Bonds are doing their own thing. And, well, with everything happening globally, policy changes potentially on the horizon.
It's completely understandable that volatility makes anyone question, am I doing the right thing with my money? Should it be in stocks
No.
or bonds?
Exactly. It feels chaotic. So for this deep dive, we're not going to try and predict next week or next year. Impossible, right?
Right. Crystal balls are notoriously unreliable in finance.
Huh, yeah. Instead, we want to step back. Look at the long history. What does the data actually tell us about how stocks and bonds have performed over time?
The goal really is to give you some context, some historical perspective to help you think about your own situation, your personal decisions.
Perfect. And we're drawing insights from a Motley Fool piece titled, Should You Be Invested in Stocks or Bonds Right Now? Here's what history says. So let's start with stocks. They get a lot of the headlines.
They do. And for good reason, historically speaking. If you look back over, say, the last century, U.S. stocks have delivered average annual returns of somewhere around 10%.
10% average. That sounds pretty good.
It is, especially when you factor in the power of compounding. That's where the real magic happens over the long term.
Okay, can you give us an example of that? Make it real?
Sure. Imagine you invest $10,000 every single year. And let's say you manage to get that historical average return of 10%.
Okay.
Over 50 years, a long time granted, but over 50 years, that consistent investment wouldn't just be the $500,000 you put in. It could potentially grow to just under $13 million.
Yeah, okay. That really paints a picture of the long-term potential for building wealth.
It absolutely does. It shows why stocks are often seen as the engine for long-term growth for your portfolio.
But there's always a but, isn't there?
Hmm.
That growth isn't a smooth ride. The article definitely highlights the downside risk.
That's crucial. Yes. Higher potential returns almost always come with higher risk. And for stocks, that risk often shows up as market drawdowns, big drops.
How big are we talking?
Well, the data since 1928 shows 27 times where the S&P 500, that's a broad U.S. market index, fell by more than 20%.
27 bear markets since 1928, so roughly one every 3 or 4 years on average.
Something like that, though they aren't evenly spaced, of course. And these aren't just little blips. A 20%, 30%, even 40% drop.
Yeah.
It happens.
And the recovery can take time, too.
Exactly. It might take months, sometimes years, for the market to climb back to where it was.
And that's where the timing becomes really important for you, the
Yeah.
investor, right? If you need the money soon.
Precisely. Think about needing funds for a down payment on a house. Or maybe you're starting a business.
Right.
Or, you're retiring and need to start withdrawing living expenses.
Yeah.
If the market tanks right before you need to pull out a significant chunk of cash, well, that can seriously derail your plans. Selling low is something you really want to avoid if possible.
So the key message for stocks seems to be, think long-term, like really long-term. The article suggests money you won't need for at least, 10 years?
That's a common guideline, yes.
Yeah.
At least 10 years gives you a better chance of riding out those inevitable downturns and benefiting from the potential long-term growth.
Okay, makes sense. Let's switch over to bonds then. They're often talked about as the safer, more stable option.
That's the general reputation, and it holds true to a degree. Historically, bonds, especially U.S. Treasury bonds, have been much less volatile than stocks.
Less volatile, but also lower returns.
Generally, yes. Over that same last 100 years, U.S. Treasuries averaged around 5% annually. But, and this is important.
Another but.
Yeah, inflation.
Yeah.
Have to factor in inflation. After accounting for rising prices, the real return on those bonds has often been closer to half that 5% figure, maybe 2 or 3%.
So your money grew, but its actual purchasing power didn't increase nearly as much as with stocks.
Correct. And sometimes, if inflation is really high, your real return on bonds can even be negative. You're technically losing purchasing power even while earning interest.
Okay, so lower returns, potentially eroded by inflation,
Yeah.
but the upside is stability.
Exactly. When bond markets experience downturns, they're typically much shallower than stock market crashes. Think maybe 10%, perhaps up to 20% in a really bad bond bear market compared to the 20% plus drops we see more often in stocks.
Right.
That relative stability is valuable if you need to preserve your capital for goals that are closer in time, maybe those near-term expenses we talked about.
Like that house down payment again. You wouldn't want that fund dropping 30% right before you need it.
Precisely. Bonds can help protect that principal value better in the short term.
Now, you mentioned inflation being a challenge for bonds. The article brings this up too, especially thinking about periods like after World War II.
Yes, high inflation is the natural enemy of traditional fixed income bonds. If inflation is running at, say, 6% and your bond is paying 4%, you're losing 2% in real terms each year.
So how can you, as an investor, deal with that risk? Does the article offer any solutions?
It does mention one specific type of bond designed for this: Treasury Inflation-Protected Securities, or TIPS.
TPS. Okay, how do they work?
They're pretty clever, actually. The principal value of a TIPS bond adjusts up or down based on changes in the Consumer Price Index, the CPI, which is our main measure of inflation.
Ah, so if inflation goes up, the value of your bond goes up too.
That's the idea. The principal increases, and the interest payments, which are calculated as a percentage of that principal, also increase. It helps your investment keep pace with inflation.
So that helps protect your purchasing power, which is a key concern with standard bonds.
Exactly. It's a tool for you to consider, especially if you're holding bonds for the medium or long term and are worried about inflation eating away at your savings.
Okay, so recapping a bit. Stocks offer higher growth potential but come with significant drawdown risk, best for the long haul. Bonds offer more stability, lower returns, and you need to watch out for inflation, maybe using TPS.
That's a good summary of the historical trade-offs.
But the article really stresses that it's not just about picking stocks or bonds based on, say, what you think will happen next year.
Absolutely not. Trying to time the market like that, guessing whether 2025 will be better for stocks or bonds,
Yeah.
it's incredibly difficult, even for professionals, and often counterproductive for individual investors.
So what should drive the decision?
It really comes down to you, your personal financial situation, your goals, and crucially, your time horizon. When do you need the money?
The article gives some examples based on life stages to make this concrete for people listening. Can we touch on those?
Sure. So, for instance, if you're younger, maybe under 40, decades away from retirement, no major cash needs coming up soon.
You have time on your side?
Exactly. You might be comfortable having a portfolio heavily weighted towards stocks, maybe 80% or even more. You have time to recover from potential market drops and hopefully capture that long-term growth.
Okay. What about someone in, say, their 40s or 50s? Maybe starting a family, saving for college and retirement, perhaps a house upgrade.
Right. More competing goals, some nearer term than others. For someone like that, a more balanced approach is often suggested. Something like the classic 60% stocks, 40% bonds.
The 60-40 split. We hear about that a lot.
Yeah, it aims to provide a blend. Still capturing growth potential from stocks, but adding some stability and diversification from bonds to smooth out the ride a bit.
Got it. And then what about someone later in life, maybe already retired and living off their savings, say, over 75?
Well, at that stage, the primary goal often shifts from growing wealth to preserving wealth and generating reliable income.
So protecting what you have becomes more important.
Precisely. So for that person, a portfolio leaning more heavily towards bonds, maybe 60% or 70% bonds or even more, might make sense. The focus is on stability and reducing the risk of a major loss just when you need the money for living expenses.
These are just examples, of course, but they illustrate the point really well. Your own life stage, your timeline, your needs, that's what dictates the mix.
Absolutely. It's not about market forecasts. It's about your personal financial plan over the long term.
Okay, so wrapping this up, the big picture from history via the Motley Fool's analysis seems clear. Stocks, higher potential growth, significant risk, best for money you don't need for many years.
Right. And bonds. More stability, lower returns, watch out for inflation, maybe consider TIPS for protection.
And the ultimate decision on how much of each is right for you doesn't come from guessing market winners.
No, it comes from understanding your own goals, your timeline for needing the money, and importantly, your own tolerance for risk. How much volatility can you stomach?
That's a really key point. So the final thought to leave listeners with.
I think it's this. History gives us invaluable context, right? It shows us the patterns, the trade-offs. But the most critical factor in your investment journey is truly understanding yourself.
What does long-term mean for you? What does near-term mean?
Exactly. And how comfortable are you really with seeing your investments go up and down? Answering those questions honestly is probably more important than any market prediction. It's an ongoing conversation with yourself about your financial future.
Well said. A continuous process of self-assessment matched with understanding these long-term investment principles.
Couldn't agree more.